Hey everybody, happy Wednesday to you. Time for managing an options portfolio. My name, Brent Moores, and I'm joined alongside Ben Watson, who's helping me out in the chat. So as you have questions, feel free to type those questions in the chat between Ben and myself. We'll do our best to get to those. See some familiar names in the chat. Appreciate each of you. And if you're new, well, we're glad you're one of our new friends here. Glad you're joining us. And if you're watching on a recording, that's great too. You can follow Ben and myself on X for additional content throughout the week, additional financial. If you're interested in financial markets, I think it's a good thing to do. At Brent Moore CS, at Ben Watson CS. Now, we're going to be talking about managing an options portfolio, managing various types of trades today. Focus maybe a little bit more on calendar spreads today, but we'll try and hit up a variety of trades as we usually do in this webcast. But before we get too far into this, let me just mention that options do carry a high level of risk and are not suitable for all investors. And multiple leg option strategies will involve multiple transaction costs. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And that's different than the paper money application. The paper money application doesn't assign any short contracts early. So just realize there's a few differences between paper money and the live account. Paper money software application is provided for educational purposes only, though Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal. Past performance is no guarantee of future results there. Let's take a look at the markets because I think, yes, folks, that is a new all-time high on the S&P 500 today. So markets, little extended maybe. If you're losing the 20-day moving average, I'm not saying I don't know what the market's going to do, but what I'd say is, sometimes when you got the 20-day moving average and we kind of extend above it, it kind of comes back a little bit, right? Extend above it, kind of comes back. Extend above it, comes back. And so where's this going from here? I don't know. But wouldn't it shock me to see a little bit of a breather in the market? Of course, we have a couple things that can affect what the market as a whole does. The two that come to mind right now, we've got a Fed announcement in a couple hours. Where, I think most people think the market seems to be pricing in a 25 basis point cut. But really, maybe more interesting is kind of reading between the lines and maybe reading explicitly as well what is said by the Fed and by Chairman Powell about the future course of monetary policy. That can certainly affect the markets. Also, we got earnings, big earnings week, okay? Meta, Google, Microsoft today. I said Google, Alphabet, I guess. Apple, Amazon tomorrow. Those are big companies that can certainly push this S&P 500 around a fair amount. So we'll see what happens going forward with the markets. But you know what? Even if we do flag a little bit, it doesn't change the fact that we've been trending up. And for trend traders, that is a bullish sign. If you're not a trend trader, maybe you're just going off market valuations. Maybe you think the market is a little bit overvalued. I don't know. But let's take a look, because I kind of was looking at a trade just the other day. It was on Friday in our condors, calendars, and butterflies class at Costco. Because what we have on Costco is we have a calendar spread. And it's interesting how quickly things can change. Because when we were looking at this on Friday, at this Costco trade at Friday, we had a big whopping gain on this showing. Well, you know what? It just shows the market shifts. The market can change. Now, right now it's showing as $60. A little while ago today, it was showing as in the red. but a few days ago, it was several $100s in the green. So things have changed. And so that kind of begs the question of when do we roll these contracts? When do we close out these contracts? And so let's start with calendar spreads and talk about that. What is rolling? When would we consider rolling? Because we considered rolling on Friday, but I was kind of running a little shy on time. And then I said, well, that would be a good thing to talk about in our Managing Options Portfolio webcast. So here we are. When we talk about rolling, specifically on a calendar spread, we're talking about closing out a contract and opening a new one in its place. So there's nothing fancy about it. What we'd be doing in this case is we'd be taking this contract that expires in 16 days and saying, well, maybe we'll sell a different one. Maybe one that expires in, I don't know, about 30 days or something like that. And if we exit this one and we do a new one, and we'll say 2 contracts because that's what we have, and we say that's 30 days, and then the net result is you go, it just kind of looks like we moved this one out in time. We just pushed it out in time. Well, technically we didn't just push it out in time. It's a separate contract, but that's what we're talking about rolling. When we talk about rolling something out, we can do that. Now, in addition to rolling something out, we can roll it up or down. In other words, we can adjust the strike price in that case as well. But that's what we're talking about when we roll. Now, the other choice is we could just close it out if we want to, or we could let it be. So when do we roll is the question. Well, let's do this. Let's talk about how we manage calendars. Number one, remember, when you're looking at any option trade, you got to think of scenarios if they're good or bad or just kind of so-so. If things technically break down, then we're probably going to look to get out. In other words, if Costco, when we do a calendar spread, and this one's at the 940 strike price, where do we want the stock to go? We want it to go to 940, right? And so if the stock's around 940 when we enter it, it's a kind of neutral-ish trade. If the stock's a little bit below 940 when we enter it, then we want the stock to go up towards that 940. Remember, that's our goal. If that goal becomes like something we don't foresee happening, we don't foresee the stock heading towards that strike price, then we may just close out the trade. So that's the bad scenario. If a calendar spread which starts out neutral turns quite bullish or quite bearish, we may look just to get out. Okay, fair enough. What if the stock's what if it's kind of going along and it's doing okay? Well, that's okay. It's a time decay, it's a theta positive trade, and we may let it continue up until a certain point. And usually that certain point is about a week to go till expiration. Okay? So about a week to go to expiration. We're not quite there. We're at 16 days, so we can let this go a little bit longer and just let it run. But at a certain point, we may decide, well, I want to continue this out and do a roll and maybe bring in a credit during that roll. We may extend that out, and we'll get to that in a sec. But there's some other scenarios you may consider. One, on the short contract, if the short contract has made most of what it can make, we'll say 80% for our purposes here, then we may decide to close it or roll it. Okay? So we traded the short contract for $23. We sold it for $23 up front. And remember, there's 2 contracts here on that. Right now, it's at about $7.50. So we've made most of what we can make. 80% would be roughly $5. So we're not quite at that 80% mark, but we're getting relatively close there. And let me mention one other circumstance where we may consider closing or rolling this calendar spread. And that is, if we got a little ways to go to expiration and the stock is right at our strike price, and this was kind of the scenario we were at the other day when we were showing that big profit, I think. If we're right at that 940, right where we want it to be, that's often a very good time to consider closing or rolling, because we're probably at a pretty good gain at that point. Can't make any guarantees on that. But if the stock is at the strike price, we're probably at a pretty good gain. Well, let's look at see what's happened at Costco. When we were looking at Costco, this was on Friday. Let's see, today's Wednesday, Tuesday, Monday, Friday. Look where the stock was. It was right around 940. That's why that was showing this nice profitable situation. Really, it would have been ideal to roll on Friday. But, here it is what it is. Here's the thing. I want to show you how to roll, and we'll do that, bring in a credit, but with a little bit of a caveat. If you're looking at this trade, and let's say you're trading along in your paper money here, and you're going, you know what, Brent, this is just looking more bearish than anything to me. If that were your forecast, you would probably just decide to exit the trade. Get out of the whole shebang. You can get out right now with a little bit of a profit, which would be nice, $145 on this right now. That actually wouldn't be such a terrible scenario. So you can do that. So let's look to roll this out. What are we going to roll? Okay. What are we going to roll? Well, we're getting out of the November 14th, 940 call. Probably more often than not, I'm going to look to roll out a couple weeks at a time at least. Okay. In other words, I can roll out just a week or maybe even less than that, depending on what kind of contract you're looking at. But you may be able to look at a week, but you're not getting that big a time decay difference or time difference between those contracts. So I'm going to look to roll that 940 in anticipation that Costco may turn bullish on us. I'm going to look to roll that 940 out to a 940 a little bit farther in time. Now, the other choice is I could change the strike price as well. Okay, I can roll it down a little bit. And if we were to roll it down, let's say we rolled it down to a 920 strike or something like that. And the net result is we have the 940 long call and the 920 short call. At that point, it's no longer what we'd call a calendar spread. It's what we'd call a diagonal spread. It just changes the polarity of the trade a little bit. But if we want to roll this, how are we going to do it? This is how we're going to do it. We're going to go to the trade tab. No, actually, you know what we can do? We can just actually right click right here on this contract, and we can say, create a rolling order. I'm just going to say calendar. I'm just going to click on that. And we're going from the 940 November 14th to, and I mentioned a couple weeks, so I'm going to look to go a couple weeks. So I'm going to go the 28th of November. And notice what it tells us. It says this trade right here would bring in about a $430 credit. Well, that's nice. Now, we bring in the credit. It's after we roll, by the way, if we do this roll, after we roll, this PL open is going to not look so good. And I'll tell you why. Because this nice $3,000 PL open, we're closing out that contract. It's essentially going to zero out. And this whole trade, instead of showing a $160 PL open, it's going to show roughly a $3,000 or $2,900 PL loss at that point. So these PL opens can be very misleading on your trades in that regard, in terms of the whole picture of how things work. Okay? All right. Now, let me just address a couple things in the chat. Momo says, do you only discuss calendar spreads in the class? No, we're starting out with calendar spreads. We'll look at some other types of trades today. Okay? We're going to get to that in just a little bit there. Also, there's a survey link in the chat. You know what? We appreciate your feedback. Okay? We appreciate your feedback. So give us some feedback. I'll read all those topic things you need discussed. You can add that in there as well. So that's how you roll. We're technically exiting out of the November 14th contract. We're selling the new November 28th contract. And it's going to give us a nice little credit. But remember, there's multiple contract fees that occur when you roll. Okay, just doing it on one ticket doesn't save you the transaction costs. There are transaction costs. So I'm going to click on confirm and send here, and I'm just going to send that order. Okay, and it filled. And now take a look at it. Here's Costco. Let me go to move that out of the way, go to my calendar. And when we look at this, you're going to see, oh, this just looks dreadful, doesn't it? Well, again, it doesn't give the whole picture there on that. Okay, so let's move on. I want to continue on the topic of calendar spreads a little bit longer, and then we will move to other types of trades. But here's what I want to do. I want to consider a new calendar spread and just kind of discuss how they work a little bit. So here's Lowe's. Okay, let's just think of, that home improvement store. And we're only doing calendar spreads if we're kind of neutral on these. I'm going to say, you know what? It went up, it went down. It looks like it's maybe stabilizing somewhere in this range. So I'm going to look at a calendar spread on this. But let's do this. Let's go to the trade tab. And kind of typically, when the way in this webcast and in my other webcasts I teach them is, although it's not a recommendation necessarily or a way you have to do it, it's just the rules we use in the classes. For our short contract, we're going to look out 20 to 30 days or so, maybe. And I'm going to go to the 240 strike, and I'm going to look to sell that. So I'm just going to click on the bid price there. Okay. And I don't need that many contracts there. And I'm going to go out to about maybe 50 days, 40, 50 days or so out here. I'm going to go to that 240 strike, and I'm going to click on the click on the ask price. And that gives me this calendar spread. But before we actually look to place the trade, what I want to point out is this. If I go to Delta Gamma Theta Vega, if I bring up my Greeks, and let's just kind of focus on this 240 strike here. Because what I want to point out is this. There's a short contract and there's a long contract. And there's two Greeks I want to focus on here right now. Theta and Vega. Look at the short contract. Look at our theta on our short contract. That's the daily time decay. We're selling it. So when you sell something, we got to take the opposite sign on this. So instead of negative 16, it's 16 cents times the multiplier, which is 100, $16 a day, okay, on the short contract. Long contract, it's about half that much. So 0.08. And that's showing negative 0.08. It's long, so we don't take the negative of that, so it's still negative. So our net theta is about 0.08. That's one reason why people do calendar spreads. They're more of a neutral type trade. Remember, we're going to target wherever our strike is, in this case, 240. Okay. So that's our goal. And you're not going to do this if you're very bullish or very bearish. Remember, this is our target. But they're positive theta trades because the short contract has the higher theta than the long contract. The short contract drives the theta. Look, long contract, the theta is working against us. Short contract, theta is working for us. But the short contract, it's bigger. So there we go. Now, let's change focus for a sec. Let's talk about Vega. Vega is a measure of how much this trade is going to benefit or be hurt by changes in implied volatility. Now, with Theta, we said the short contract was the driver on that. Okay, it was the bigger factor there. Well, let's look at let's look at Vega. Okay, Vega, 24 cents, and it's a short contract, so it's negative. So it's negative 0.24. And let's see, 240 strike. And the long contract is 36.36. Again, our multiplier is 100 there. Net difference, because it's a spread, is about 0.12. Notice which is the driver of this time. The long contract, December contract in this example, is the one that is driving the trade. And so we're positive net vega means we benefit if implied volatilities go up. This is a positive vega trade. When do you do calendars as opposed to, say, an iron condor? Well, iron condors are theta positive, okay? Iron condors are theta positive. The time decay helps us out. But they're also, they're vega negative. Calendars are vega positive. So that may be one distinguishing factor between those two. And when you decide to do one versus the other, given that they're both kind of neutral-ish, time decay positive, theta positive trades. Okay, so vega is the difference. So if you're looking at this and going, okay, here's lows, I want my implied volatilities to do what? Well, I want them to go up. Okay, and if you think implied volatilities are going to continue to go up, it may be a trade for you. If you assuming it's going to be kind of neutral-ish, if you think implied volatilities are going to drop a lot, then you probably aren't going to do that type of trade. Now, earnings is a factor. When do we have earnings? Answer, I don't know. Let's look. Earnings. Somehow I switched symbols. I don't know how that happened. Let's go back to lows. Earnings is November 19th. So in this case, unless we want to tackle earnings on a calendar spread, which, by the way, I'm planning on covering in this week's Condors, Calendars, and Butterflies class on Fridays. If you want to talk about calendars over earnings, you can check that out then on Fridays at 2 o'clock Eastern time. Do it. But for our purposes right here, I'm going to avoid earnings. So I want to be out by November 19th. If I do this trade, I'm going to plan on being out by November 19th, because remember, I'm getting out about a week to go till expiration. November 19th is 2 days. November 21st is the expiration on that, before expiration. So we'll plan on being out before then. Time decay should help us out on that trade there, okay? Let's go. I'm going to sell the front month. I'm going to buy the back month. And there's my calendar spread. Remember, with the calendar spread, your max loss on calendar spreads is your initial debit. So in this case, it'd be somewhere, we may change the price here a little bit. We'll say 210 here, okay? So 210 would be, if we fill there, our max loss on that trade there. So I'm going to confirm and send $210. I'm not factoring commissions on this trade. There, and there we go. So let's take a look though at lows on the Analyze tab and just look at our risk profile. This is what it looks like, okay? This is what it looks like. Kind of this familiar tint type profit loss graph. Where's our peak? Our peak is going to be at our center strike right there, center strike, 240, okay? And if it goes too far bullish or too far bearish, that's bad news for us. So there we go. There's a trade. And we'll manage this the same way we discussed managing other ones. We're going to have the good scenario in mind, the bad scenario in mind, and and a time exit as well. Let's look at possibly some other. Well, let's continue with calendars for one more minute here, and then we'll get on to some different types of trades. But look, I've got a calendar spread, same strike, different expirations on FCX. How are we doing overall? Doing okay overall. up about 52 bucks on this. Still got 23 days to go expiration. Do we anticipate it remaining kind of in this $42 range? Let's go to FCX. And so kind of in this range. Yeah, that seems reasonable. We're not right at 42. I'm just going to let that run, or let that bake, so to speak. We have time decay on our side. We're going to let that one sit there on this. Let's look at Alphabet. Well, look at this. You see these little symbols right here? Earnings are coming up. In fact, to be honest, earnings are coming up in about like 4 hours or less. So, yeah, I'm not going to plan on holding this through earnings. Plus, you know what? We're below, we're about a week to go to expiration now. If I wanted to hold this through earnings, I could, but that's kind of a special circumstance. For our purposes, we're going to get out of this trade as a whole here. Okay, so let me control, right click. We're going to create a closing order. We're going to get out of that. And let me just do this and confirm and send. And it's thinking. Okay, we'll see if that fills. We'll let that go. Okay, let's change course here. We're going to get out of calendars for a sec. Let's first go to just a diagonal. Look, here's a diagonal spread we have on Nike. We've rolled this in the past, and let's look to roll it again. Look, why would we roll? Number one, we're getting close to expiration. There we go. We just filled on that Alphabet. We're getting relatively close to expiration. Number two, when we sold this, we brought in 87 bucks, and we could buy it back for about 10 cents now. Let's roll that out. Look, this is a leap, this $50 call. So it's a diagonal. Let's roll this out to about a month's worth of time, $74 call, and bring in a credit. Okay, so this is going to be a credit transaction here. I'm going to right click on this, if it will let me. That's kind of funny. I'm not sure why it's not letting me. Okay. See if it will let me do that. I want to. Okay. Oh, there we go. Now it worked. We're going to create a rolling order, and we're going from November 7th. I'm going to go out about a month here, and let's go to December 5th here. And that's going to bring in about a $52 credit there on that. Okay. Now, Chris in the chat said, is that what we call a poor man's cover call? That's kind of a colloquial term. Yes, that is exactly what it is. And why do we call it that way? Well, let me show you. I'll show you that in a sec. But yeah, good eye there, Chris. You're absolutely correct on that. Okay. So let me do this. We'll roll. I'm going to just roll that. Okay. Now let's look at Nike. Let me get to the monitor tab. And let's see, account statement. We're going to go to Nike. This will load. Let's go to NKE. And I need much more than 8 days back from today. So let's go 180 days back. How about? Probably has more than what we need, but we originally did this. And let me just look real quick on this. Come on, I don't want that. A $50 call was the initial transaction on this. So here's the $50 call. This was a Leaps call. We bought this, and at the same time, that was a closing transaction. Okay, so we bought this, kind of weird. I don't know what happened on that. Okay, excuse me, ignore that one. We sold the 81 call, and we bought the $50 call. Okay, now it cost us money Many of you are accustomed to buying a stock and selling a call against the stock, covered call. Well, this, instead of buying the stock and selling the call against this, what we did is we bought a LEAPS contract, a long-term expiration, September of 2026 expiration. It was a lot cheaper than buying 100 shares of stock, okay? A lot cheaper than buying 100 shares of stock at the time. It's not a covered call. We call it a poor man's covered call. Technically, it's a diagonal spread, though. There's a difference between doing a LEAPS and contract and buying the stock. One is you don't get a dividend with the LEAPS, with the option. Number two, it expires. There's more leverage, stuff like that. But here's the point. We entered this trade initially, but then what we did is we did what we've been doing. We rolled it. We rolled it for a $156 credit. We rolled it again for an $85 credit. We've rolled it again for a $52 credit. Nike has not cooperated. It's been going down. We're actually net losing on this trade overall, but a lot less than we otherwise would have, because we've brought in a roughly $300 worth of credits on this trade at this point. So we just rolled it again, and time decay should be benefiting us again on this, and it is. Not huge, but it is there. And that's what we're going to do on this. Okay, let me go and we'll move on to a different type of trade here. Let me just check questions in the chat. Anything you sell against the LEAPS needs to be more than 80 strike, or if you lose money in the trade, however, over time. Okay, but wait, let me just read this again here. Josh says, anything you sell against the LEAPS needs to be with a strike of 80 or more, or you lose money on the trade. Not necessarily. Oh, then you say over time, as you collect premium, you can theoretically lower the strike. Yes, correct. I would say that is true, Josh. Over time, what we can do is we can inch down that strike a little bit and hopefully bring in a credit along the way and bring in multiple credits and eventually ramp that down. We don't have to keep the same strike each time. This time, I kept the same strike, but we can roll that strike down as we go. In fact, I think we started with an $81, if I remember correctly, strike, and we've rolled it down to an 80. We may roll it down further. Rolling it down further, we can bring in a bigger credit there. All right? Okay, let's move on here. I want to point out something to you. Sometimes when you look at, this is a little bit of a different topic, but it's something that you may see happens in your account, and I want you to be aware of it. I have this UNH stuff here, and I go, UNH, I have this like call and put, looks kind of familiar. I thought I had a synthetic on this, but it's showing zero, and this, what happens is sometimes when you're messing around with things, which I do a lot on this, your trades get disconnected from one another. In other words, I have this synthetic up here, okay? This is a long stock synthetic. 350 call, 350 put, short put, I should say. This is kind of mimicking, in some ways, a stock. It's not a stock, it's different. Again, these expire, no dividends, stuff like that, leverage. But do you see how this isn't showing my stop and this isn't showing a trade? What do you do if these get put into different categories? Let me just move this up here. You see, so I have this in different groups. Well, what happens is this is in the unallocated group. The way to put, and I don't think this is going to let me move it. Maybe it will. Oh, it'll let me move to this group. Let's go to our, wait a second. Sorry. What I was going to say is I don't think it's going to let me move this one to a group, okay? Do you see it doesn't give me the choice, move to group? So what the trick on this is, all you need to do is go to this one, unallocate it just for a sec. Now these two are reunited, my trades and my contracts. Now if I move this back to the group I want it to go to, it should, in theory, all move together. And sure enough, it's no longer in the unallocated group, and it is now all together, happy family again, there. All right? Now, this is a long stock synthetic. How are we going to manage this? For the most part, we're going to manage it the same way we manage a stock. If I'm bullish on the stock, I still have time till expiration. I've got 51 days till expiration. Still have more than a month till expiration. I'm just going to stick with it. If I turn bearish on this, then I'm going to look to exit the trade. Let me go to UNH. Okay, here's the UNH chart. Am I bearish on it? No, I mean, I think the trend's going up. I think we're going to stick with this here in this case. All right. So that's just going to be managed on that. To a large extent, we're going to continue to manage it just as we would a stock trade there. Okay. And I do have a sell order on this when it marks below 335. So we do have a stop on that, just in case. You could adjust that if you wanted to, but I'm going to keep it as is. Let's move on to some other types of trades here. Let's look at, say, some long verticals. How are we going to manage those? Well, let's start with Abbott. Abbott's doing fairly well. We have a nice little profit on it. It's a 125, 130 long put vertical, okay? Long put vertical. So we want the stock to go down, bearish. Right now, it's just a smidge above our lower strike. So things are going okay. We still have 23 days to go. When we get out a week or so, we're probably going to get out. If we're no longer bearish on this, we're probably going to get out. Are we bearish? Yeah, I'm going to say we're going to go with the trend here for our purposes today. We're going to say if we've made most of what we can make on this, we're probably going to get out. Well, how much can we make on this? Well, look, this is at expiration, it can be worth $5 difference there. Five-point difference there on that. Okay, we have two contracts, but 5-point difference. Right now, the current difference is roughly $3. So we still have about $2 per contract times two contracts, okay? That's $4 times our multiplier is $400. We could still make up to $400. It could still be worth up to $400 more than it is right now on that. So I could go either way. There's something to be said, by the way, for taking your profits. And it's not you don't want to cut profits too short, but that's a reasonable profit there on that one. So I'm going to leave this on in this case, but you certainly could make the case of just taking the money and run. And I'm not going to take the time to do a poll here as to what to do, but I imagine if I were to poll you guys, I'd probably have kind of a mixed response on what to do with Abbott. Now, that's the good scenario. Here's the bad scenario. This is the ugly one. BlackRock. This is a long call vertical. We're bullish on this, and it's not looking good, okay? It's a more expensive stock, so it tends to move more in terms of like profit loss here. We're bullish on this. Are we still bullish on this? Well, that's a concern. I mean, I think that was a support level we were looking at, and we're kind of right there. What I would say is this: we could either get out, or it may make sense to put in a stop on this. Okay. Let's put in a stop around just over $1,100 here. Okay. My number's moving around, just over $1,100. How do I do this? Okay. Well, look, I'm just going to highlight both of these. I'm going to right click on this. If we're not going to get out right now, I'm going to click sell this. But what I'm going to do is I'm going to click on market and make it good till canceled. And we said, I want to get out if it's just a little bit over $1,100. Symbol, BLK, mark, greater than or equal to, not greater than, less than or equal to. And we said just a little bit over that, 1102. Okay. I now have a stop on that to try and help us if this continues to go down. I don't want to take a max loss on this. I don't want to take anywhere near a max loss. Now, what you can do is you can always go to the Analyze tab, look at your stock, and we can kind of see where we're at, 11:15:19. That's where you can see this has moved a long ways against us. Let me just kind of stretch this out a little. Come on. Stretch this out a little bit here so we can see it a little bit better. Okay. So this is where we're at right now. We're not near a max loss, but I want to prevent that max loss here. So that's why we put on that stop there on that, and we'll let that set. Now, question in the chat. Let's look at the Greeks on Abbott. Well, let's go look at the Greeks on Abbott. So you can look at your combined Greeks. Okay. We know on this trade, our time decay is benefiting us on this. Okay. That can be a factor in deciding, do I want to be patient with this trade or not? In the case of BlackRock, our theta is negative on this. Time decay is working against us. And so we don't want to be very patient with that trade. With Abbott, time decay is benefiting us. So if the stock kind of does nothing, well, we can let it sit. We can let it sit a little bit. And the time decay should help us out. Now, that can certainly backfire if the stock goes completely against us, but that is one factor in terms of Greeks, in terms of managing these. Is theta benefiting you or is it hurting you? You can be more patient if theta is benefiting you. Okay, Vega, it's just kind of a matter of where you think implied volatilities are going. In the case of Abbott, it's a negative Vega. We benefit if implied volatilities go down. BlackRock, it's a positive Vega. We benefit if implied volatilities go up. So let me do this, and then I think we need to wrap it here. Here's Abbott, and you can look at those implied volatilities. They're low. We still have a ways to go to earnings. Coming up within about a month or so of earnings, we're probably going to see those implied volatilities ramp up quite a bit. Right now, I'm not sure implied volatility is going to be major impact on that. One last trade that I want to just point out here, and then I got to wrap it. I'm not going to be able to do the whole trade. But if you look at Caterpillar, look at what we have on Cat. Cat, we just have a long, we have a leaps, okay? It's been going great for us. As long as we're bullish on this, we're going to stick with it, but we may move up the stop on this. Right now, I do have a stop on this at the fifth. Hold on. I don't know. I have time to do this. Price, market. I have a $52 stop on that. That is, it's time to move that stop up. Okay. So I'm going to move that stop up here. And there we go. Folks, Well, actually, before I do that, let me just mention this. If you're not bullish on anymore, you would just get out. But a $52 stop on a Leaps that is now at $180, that's too low of a stop probably on that. Okay. So there we go. All right. What did we talk about? Well, we focused the first part of the session on calendars, on rolling trades, rolling calendars. Reminder, there is a survey link in the chat. We appreciate you filling out that survey and giving us feedback. After we talked about rolling calendars and we actually inputted a calendar, a new calendar trade, we looked at different calendar spreads. We looked at a diagonal spread. We looked at a long synthetic. We looked at long verticals, and finishing up with the leaps and changing the leaps there. Thank you, Ben, for helping me out, of course, as always. And thanks to each of you taking a little time out of your day for joining me. I appreciate you. And just a reminder, coming up next, we have trading price patterns. And we'll see you all same time next week. Bye-bye, everybody.